Good evening, Sri Lanka. Welcome to yet another episode on Law and Order. We're going to talk about a very opportune topic, a timely and very interesting topic right now in the country, which is the stock market, because there's so much has happened over the last 1 month or so. There's so much of talk about what's going on, why is it moving up, and all of a sudden there's crashes and all of that. You look at record numbers over the last month or so. To talk more about it and give us the legal perspective about the whole thing, we do have with us today in the studios Mr. Nishan Sydney Premitharatna, the sector specialist of Ministry of Justice, Commercial Law Reforms, and also the regional representative of International Chamber of Commerce, or the YAF. A very good evening to you, Nishan.
Good evening, Ishan. Thank you very much. It's always been an honor and privilege to be here at Law and Order.
And we're going to start off with giving everyone out there the perspective of what this stock market is all about, because I think there is so much legislation behind it and so much that happens. But in a layman's point of view, what is the stock market and what really happens there?
Yeah, so Ishan, I think most people are confused with the market. They don't know what exactly is happening, why is the stock market going up, what is actually traded in the stock market. So it's like any other market. You go to the PETA market, for an example, and you want to buy some vegetables. On one day the vegetable prices will be high, on the other day it will be low. So it works on demand and supply. Now, unlike vegetables, what is sold or what is bought and purchased by parties are shares. So shares are issued by companies, and those shares are able to be traded between one party and another party, and a platform has been created which is called the Colombo Stock Exchange, on which you are able to buy and sell shares depending on the demand for the shares. So the question then arises as to how these shares can be listed in the market. So the basic elements of company law is that ownership to a company emanates from shares. So if you and I, Ishan, we have a company called Ishan and Sydney Private Limited, we will have shares issued to ourselves, and both of us will have 50% hypothetically, and then we want the company to be listed in the market, where we want to generate more equity or capital so that we can expand our company. So for that purpose we would have to have the ability to issue more shares. And if a company, a private company, converts itself subject to the listing rules, subject to the laws of regulation, and is able to call itself a PLC, a public quoted company, then they are able to be listed in the market, and those shares, it's not shares of private limited companies which can be traded in the stock market. It is only shares of listed companies which are able to be traded. So on a very simple layman perspective, it is these shares which are traded in the market. Several factors affect those shares, not merely people wanting to buy a share because of speculation. If you really want to be an investor in the market, you might have to do your own research and understand which areas and which companies you want to buy. So that is a different matter in respect of investment. But on a very simple sense, it's the stock market is about buying and selling shares of companies.
And Nishan, moving from that to the topic that you mentioned about private limited companies and public liabilities and all of that. So can all companies be listed, and what are the criteria that you need to fulfill in order to be listed in the Colombo Stock Exchange?
So there is the regulator, the ultimate regulator of securities and exchange is the Security and Exchange Commission, the SEC. And the SEC has under it the CSE, the Colombo Stock Exchange, that is a private limited company, and the Colombo Stock Exchange has a set of listing rules. So those listing rules have to be satisfied in order for a company to be able to initially go out and offer its shares to the members of the general public. So in the example I gave you, say hypothetically we had 2 shares issued to each of us. So, you have 2 shares, I have 2 shares, and we want to grow, we want to generate more capital and be able to bring in investors, and we want the investors to be members of the general public. So, then we would have to decide by we would have to go there by way of an IPO, it is called an initial public offering. So, the number of shares we want to allot, what sort of capital we want to generate, we would have to prepare a prospectus, a due diligence would have to be done on our company, the SEC would have to scrutinize our company, and CSE would do that, and pursuant to all of that we are able to start issuing or effect this IPO. And once the shares are issued, you and I, being members or third parties for that matter, members in the general public, can subscribe to shares at the IPO. And once the shares are subscribed, hypothetically there were companies where when they transformed itself from private limited to a public quoted company, the IPOs were oversubscribed. So, the number of shares hypothetically which were to be issued was 1 million, there were about 5 million subscriptions effected. So, in such a situation it is deemed to be oversubscribed. So, then the company would decide whether they are going to give 1/10 or 1/5 of the initial subscription, and once it is then effected, it would come onto the stock exchange. Once the IPO has been done, the shares would be able to be traded. So, the owners or the people who initially were able to buy shares are then able to immediately on the very next day, once trading starts, it can be sold to somebody else who is interested to buy.
So, that is how a company could be listed. As Nishant clearly mentioned, there is a certain criteria that needs to be fulfilled. Once that is done, then yes, you could go into an IPO, which could lead to, as he said, oversubscription. But for instance, Nishant, for people who are looking to invest, what sort of security does this stock exchange give them?
Well, the SEC acts as the watchdog. It scrutinizes, it has a compliance unit, it monitors certain trading activity. So, hypothetically say there is a share in there is a company in the market, for no purpose whatsoever the share rises about 50% on a single day. So, in such a situation now, unfortunately or fortunately, the tendency in most markets is when a share is rising, everyone will want to get on that share. They will want to buy the share. Sometimes they don't understand why they are buying the share. They don't even believe in any other reason. They just believe on the fact that the share is increasing in price, and they will start buying the share. So, then the share when the share goes up about 50%, then the SEC can question the directors of that company, asking them, is there any price sensitive information? Are you going to do something? Are you going to acquire something? Is there going to be some form of agreement with some party? Is there any price sensitive information? So, they can question and get a clarification. So, they are able to regulate every form of activity in respect of securities which is prevailing in respect of the stock market. So, they act as the watchdog. They have penal provisions. They can even take parties to court. They can file proceedings in the magistrate court against directors for violating the listing rules, for violating this code called the Takeovers and Mergers Code. So, they have a lot of teeth. So, however, the SEC I believe is mindful that they do not want to bring in over-regulate the market. Over-regulating the market might create a negative sentiment. Now, as you properly pointed out, Ishan, the market was going up and it was reaching a certain degree of unseen heights. So, but whether that is a good thing or a bad thing is not my position to comment, but obviously the SEC also has to be mindful, because we don't want something which goes up suddenly dropping back down in the same speed. That would result in so many personnel's investments being crippled. So, all of that has to be clearly monitored. So, we have an SEC, the CSE is there. So, they act as watchdogs to oversee most forms of activity.
So, that is the legislation part of it and what they do and all of that. Moving from that, as an investor, say, as you mentioned, Nishan, if I am to invest, is it worthwhile to get into the stock exchange rather than putting your money in an FD or a fixed deposit for that matter?
Well, at this juncture, we are looking at very small percentages of interest on long-term deposits. So, the market, the share market saw gains more than 30-40% during a quarter, during a 3-month period to investors who invested in the market. And also for newcomers, even for youngsters, it's very easy to access the share market because there are applications which are functionable through your mobile device, so you can trade. You don't need a third party to handle your account. You can decide whether you're going to buy a share or you're going to sell a share on your app itself. So the market was very bullish. There was a lot of incentive to bring monies into the market, but then, as you said, the question is safety. Is there security? What if this comes down? How do you decide what share to buy? Now, unfortunately, there is no law behind that. It's a pure investment decision. So you have to be able to understand the world, the platform where we are in, the economic context. Certain industries might do well during the COVID period. There might be incentives being given by government to certain homegrown produce, and those companies might have more turnover, higher profits. The difference in exchange rate, if you are an export company, can all have a bearing in a company's growth. So ultimately, if you do your own research and decide the industrial sector you want to invest in, and then also you have the ability to look at who the board of directors in that company are, what their track record is, whether they have been continuously doing their due diligence. Because if the company is sound, by looking at the administrator, it's the directors who manage the companies. So most directors, most listed companies have to have independent non-executive directors. So they have to scrutinize the board and their activities. So you have to make the decision, you have to make it an informed decision. You should not be rushed into deciding into buying a share merely because you tell me, or your stockbroker tells you, or your friend calls you up and tells you. You have to be able to, it is not rocket science, mind you. A lot of people say this is something which we don't understand, this is Greek. It is not Greek, it's simple mechanics which affect growth. So if a company grows in value owing to certain primarily owing to the business activities increasing, the share value in the market ought to increase. That is the normal logic of it. So because all the profits are pumped into the company, and then there is capital growth, so then it will be reflected in the market price, so the share can appreciate. There are so many companies in certain sectors which I just mentioned, which have appreciated more than 200%, more than 300% during the last 9 months because of specific sectors they were involved in business activity. So it is not merely people trying to artificially get a share to go up. It is actually, there is some science and reasoning behind it. But if you buy a share which you don't know what exactly they are doing, it might suddenly go from 20 cents to 1 rupees and 2 rupees, and in about 4 days it might come back to 50 cents. So you don't know why you bought it, and if you bought it at 1 rupee 50 cents, you might get stuck at 50 cents. So you have to be very cautious and mindful.
And talking about the numbers you just mentioned, Nishan, stocks have a certain value on it, but the trading platform has a different value altogether. What's the connection, or what's the difference between the two?
So generally, now I'm not a financier, but if I am to think of buying a share in the market, I would decide on the net asset value of the company. So that net asset value of the company is a figure which demonstrates the company's present value when taking in the assets and the liabilities and setting them off, and then you can decide the net asset value. Generally, the thumb rule is that if the net asset value, say hypothetically of a company, is about 280 rupees, the net asset value is 280 rupees. So, and the trading price in the market is about 150 rupees. So, technically you are buying a share which is at a discount. 280 rupees is the net asset value, you are buying a share at 150 rupees. So, it is generally there is a likelihood that this 150 rupee share has to go up to minimum 280 rupees. So it is undervalued when it's trading in the market. So there is potential to grow, but that does not necessarily mean the share will go up immediately, because that sector might be down for certain other reasons. So there is no incentive to buy, but the security is there for an investor. Just because the stock market comes down, you have bought a share of a company. It's not, you don't buy shares in the market, you buy shares in companies. Market is merely a platform, and you have a guarantee. If that company goes into insolvency or it goes into a bankruptcy situation, you can get at 280 rupees for that share. So that is how you will generally be able to ascertain the trading price and the real value of a company. So you can ask your stockbroker, or you can even take the annual report and see the net asset value of the share.
And Nishan, you mentioned that even young ones can get involved in trading on the platform and all of that. There are mobile apps that you could do it on your own and all of that. What is the minimum age for you to be a part of the stock exchange, and how do you enroll yourself or become a liable member of the platform that you can actually start trading on?
So from the age you are able to open a current account, I think that age is 18 if I am not mistaken, you can also start opening or start buying shares in the market. So how do you do that? You have to initially you have to have an account with the Central Depository System, that is the CDS. Now the CDS is scriptless. So what does scriptless mean? It means that it is paperless. Now if you hypothetically issue your house deed, you will have a deed that will be like, it will be in the safe, and it will be a very valuable document. Or if it is your car, the vehicle registration book will be the most valuable thing, because even if you have the car and you lose your vehicle registration book, and then you go to the RMB and they have to issue a copy, it will be term copy. So when you go to sell the vehicle, it will be, people will try to discriminate it. So but now even in respect to shares, the title instrument is the share certificate. In the good olden days, in about 1950s, I think at that time, you had share certificates. So you were owning shares of these old companies, and you'll be having those share certificates, and those will be kept at your house. But the scriptless system entails that there is no share certificates anymore. So you have a unique identification number, like your NI. It's generally tagged along your NIC number. So the CSE has now evolved, where you can, if you want to go into the market tomorrow morning, you can go on to the CSE website and open an account immediately. So once you open an account, you have to give your NIC and a copy of your registration address, and then you have to decide on a broker. Now stock brokers are important because it is only through them that you can trade in the market. Now a broker does not mean an individual, it's not you or me, it's a company. So it's like a finance company. Stock brokers are given a license by the SEC. They are permitted to act for and behalf of a client and buy and sell shares for and behalf of the client. Now the broker will have, broker can't act arbitrarily, you have to give instructions to the broker. So once you tell the broker, I want you to buy X and Y and Z shares tomorrow morning, you call the broker up, the broker will then start buying, you will tell the broker the price. So once you buy the shares through the broker will have to settle the share, the prices of the payments to the other broker. So it's like a network, a payment gateway, which is also very effective. So it doesn't mean that once you buy the shares, you have to find the owner, the seller of the owner of the shares who sold it to you, you have to go and pay him the money. It doesn't work like that. There is a integrated system. So the broker will make payment to the other broker, CSE will regulate it. Payments go generally at T+3. So the day you buy, you are required to pay 3 days after that date. So that is the day you have to make payment. If you have to make payment to your broker will then make payment to the other broker who it was purchased through. So that is the system. So it is very easy to open an account. You go online on the CSE website, it is now very user friendly, and overnight from tomorrow morning you can start trading.
And Nishan, you brought in the fact that 2 brokers are involved in every transaction. So should someone who wants to invest work with the same broker at all times, or can they have multiple brokers?
You can have multiple accounts, you can have multiple brokers. So, the CDS generally, my understanding on how the CDS numbering works, it is an administrative matter, but each brokering firm will have their they'll identify themselves in front of the CDS number which has been given to you. So, the beauty about having 3-4 brokers, it is up to the investor of course to decide whether they want to, but you will get different insight from different people. One broker might be a broker who would advise you to do long term investments, the other broker might tell you, no, we will do trading, we will buy today morning and we will sell tomorrow morning, which is not the best form of investment, that is very risky. Long term investments generally is the best way to go in respect to the market. If the interest rate of banks are 10%, if you can get about 25% over a period of a year as a capital gain, then you have made a significant earning. And in addition, Ishan, you get also not merely the gain in price in the market, but most companies also pay out from their profits, and they are called dividends. So, they declare dividends. So, you can look at the shareholding of a certain company, and generally if 50%, if there is a 50% shareholder who is a foreigner, they will generally declare more dividend, because the foreigner will want to take some money out. So, you can get a dividend yield of about 6 to 7% in addition to the capital gain. So, it is a twofold return of investment. So, just because the market might come down, the company will still do well and they can pay you out of their profits.
So, that is something I think everyone out there needs to know when it comes to trading in the platform, or for that matter investing in shares. You mentioned about the broker's role, but that does not come free of charge. So, there is a particular levy or a brokerage that they charge. What are the numbers? Say if you are buying or selling, how does that work out?
Yeah. So, brokers do not get a portion of your profit, or they do not bear a portion of your loss. They just have a percentage from each transaction. So, you say hypothetically you want share in company Y, which is 400 rupees, to be purchased at 400 rupees and 100 in number. So, that will work out to be about 40,000 rupees. So, the broker is entitled, or it is an automatic deduction. The brokerage also adds on to that transaction, and also the government levy charges also add. So, the brokerage is about 1.4%, which is added on to every transaction. So, if you buy and sell, you will be paying brokerage to the brokers, will earn money out of that. But if you do a transaction, if you buy the same share and sell the same share on the same day, then the brokerage is only for one way. So, you do not need to pay brokerage, because though there are 2 transactions technically, the brokerage is only charged for one transaction.
So, that is just to clear things out for everyone out there. If there are 2 or more transactions of the same share on the same day, you only need to pay brokerage once. It does not mean that every time a transaction happens that you need to pay, but if it is on another day, yes, you got to pay. But if it is in the same day where you buy in the morning and you sell in the evening, you only need to pay brokerage once. So, that is something to have some clarity about. 1.4% is the brokerage plus the government levy. So, that amounts to another figure where that is where the government makes money of the stock exchange, if
yes,
am I right?
Yes, so from every trade. So, that is why turnover is significant for the government. Turnover is the number of transactions, and through the number of transactions a significant amount of money is exchanged between parties, and out of that a percentage is charged to the government from every transaction. If my memory serves me correct, the brokerage is 1.14% plus the government taxes. In total, it adds up to about 1.4% per transaction.
So, going to the aspect of a broker, Nishant. So, coming into the last bit of the show. So, say, does a broker have the discretion to take a call on what to buy and what not to buy on behalf of the client, or they just purely go by what the client wants them to do?
So, fundamentally you have to be able to assess your investment advisor who has been allotted to you at the brokering firm. So, your investment advisor, and his competence is also very material. If he is a new broker, how he will react, how his judgments are going to be affected, or he might be a qualified, experienced investment advisor. Those matters you have to take into consideration. Then thereafter, then you have to be able to decide whether you are going to judge his judgment or whether you are going to say all the time, no, you have to do what I tell you to do. And if you strictly categorically, because a broker technically, an investment advisor can't buy when he feels he ought to buy for you, because he's buying from your money and he's buying from your account. So if he just buys and the share comes down, he buys on the anticipation it's going to go up today. So when he sells, when you call him up in the afternoon, he tells you, I've just bought in the morning and I sold in the evening, and you made so much 50,000 rupees from that trade. It can happen the other way also. So if you have to be able to strictly tell your broker, you're not going to do anything without getting my consent. And generally it's not implied consent. Consent has to be obtained in advance. So you can give your broker the degree of flexibility for him to be able to decide whether he is going to buy when he feels he ought to buy, or whether it always has to be strictly under your purview and under your instructions.
So in the case if something goes wrong, as you mentioned, there are pluses, but there are definitely minuses as well when it comes to trading. So for instance, I've invested with a certain broker and want him to buy a certain share, I've not mentioned it, and he goes and purchases on behalf of me and I make a loss. Is there provision for me to make a complaint, or is there anything that I could do with the broker?
Definitely. So if I understood your example, Ishan, you said you have bought a share, you have told him to buy a share and he has gone and bought a different share so he has made a mistake and the share comes down. Even if it goes up, he has not followed your advice. So you can complain to the brokering firm and they will then immediately have an inquiry against him. And if his reasoning is not sufficient, because then the broker will be immediately questioned to show your authority. Generally in this context, everything happens on a telephone call, buy, sell, it just happens like that. There is no written authority given. But if you have not given and the brokering firm is informed about it, the investment advisor can be in trouble and he might have to bring in his personal funds to remunerate you.
All right, we have come to the end of today's edition of Law and Order. I think all of you probably would have understood what really happens in the stock exchange, because as Nishan very clearly mentioned, a lot of people felt that stock exchange is rocket science, it's very difficult to understand. Trading happens and you talk about different numbers and indexes and all of that, but it's as long as you're well read, as long as you know beforehand getting into it and about what you want to invest on, then things are that much easier. And if you deal with the proper broker and someone who's got the expertise, probably be on the right track to making significant improvements in whatever that you invest in. So with that, it's time for us to wind off today's edition. It's my privilege to thank Nishant Sydney Premitratna for joining us and sharing his expertise. We'll go into more detail as to what we're going to talk about when it comes to stocks exchanges and what really happens inside of trading and all of that on the next episode. Till then, it's bye-bye from us.
Thank you very much, Isha.